So you have to ask the question, what's the government most likely to do? And my bet is that they will do a lot more of and get a lot more aggressive on things that they are actually already currently doing. They will raise taxes, they will reduce services, they will reduce benefits, and they will raid private retirement accounts to fund this mess. But like I said earlier, we've known about this since the 70s. So I want to take you back there for a minute, because I personally believe that they will use this crisis to mask the real crisis. So in 1971, after a decade of the run on the dollar, with governments recognizing that we were defaulting on Bretton Woods and selling off treasuries, what was going on then? We had the Vietnam War and we had the protests. My sister was billy clubbed at Kent State. We had the oil embargo, civil rights movement, women's lib movement, 37% official inflation, and we had a stock market imploding. Could you have been a little distracted with all of those crises going on, when the real crisis was that we were reneging on Bretton Woods? We were not able to maintain that value peg, $35 to an ounce of gold. And the world, at least other central bankers and the governments, knew it. So they were running on the dollar. They were getting rid of dollars and converting into gold. So now, with everything that's going on with Syria, North Korea, etc., there's certainly a lot of things for us to pay attention to and look at to distract us from the real problem, which is the death of the debt-based fiat money standard. Now, in 71, we handed all the tools and all the control over to the bankers, and what do bankers know? They know debt, they know leverage, and they know financial engineering, which is creating products out of thin air. So I'm going to just go into a few layers, understand that there are many, many more. But according to the Federal Reserve, there's $75.5 trillion in total global financial products. Well, unless you actually physically hold a stock certificate in your hand, they are all held in accounts in street name, which means you are not the legal registered owner. You are the beneficial owner on the bottom of the heap, and DTC is the legal registered owner at the top. But all of the subsidiaries, all of the brokerage houses between DTC and you are also beneficial owners, which means that they have the legal right to use any equity in your account to borrow and then use that money however they want to. And that's called hypothecation. They can use those funds to lend them out and generate additional income, or they can speculate with them. The bottom line is, though, if these contracts are done through the City of London, which is where most of them are done, there are no limitations on the number of entities that can use this equity or the number of times this equity can be used. So that's called rehypothecation. And that establishes a foundation of leverage. And this extreme leverage creates extreme valuations. And since money is created by debt in this current money standard, that's what we're going to look at first. And understand, debt is leverage, but it's your basic leverage. So officially, there's roughly 100 trillion in debt, plus all of the unfunded liabilities, all of the promises on the social programs. I just showed you in this country, but this is true actually globally. And much of that debt, particularly since 2008, has been grown with the lowest levels of interest, again, in history. But I'd like you to notice this, which we've talked about before. You see, the pattern here looks very different than once the crisis hit. And that is an indication that the system is breaking down. But because interest rates have been held artificially at zero and even negative, you have the most expensive bond market in history. So this is how it works. These are interest rates, that's the principal of the bond. When interest rates go down, the bond principal goes up. So that's why I'm saying this is the most expensive bond market in history, and a chunk of retirement wealth is in these bonds. But that's not all. Look at the stock market. Here we are. Now I just point out that this goes through January and the markets are higher today than they were in January. Even so, as expensive as it is, it surpassed how expensive it was in 1929. The only market that was more expensive was the one in 2000. And we remember so many things changed in the mid-90s. So what are corporations doing in this environment? Well, they're buying back stock at these really expensive levels, and they're taking on debt to do that. Now, why would they be doing that? Oh, I don't know. Maybe because the insiders want to sell and take advantage of these markets. These are buys, these are sells. It should be pretty easy to see that the sells dwarf the buys. So do you really think that they know something? The people that run these corporations and these organizations, do they know something that you don't? In addition to that, real estate is at or near all-time highs. Now look, I just put a few of the store closings. This is commercial real estate. This is where the crisis hit. This is where it's sitting right now. It should be pretty obvious that all of those store closings are saying that there's an abundance of commercial real estate out there. That does not justify these lofty levels, which are at an extreme. And what about residential real estate, the house that you live in? Well, this is from the Federal Reserve. And I just want to point out this pattern from 71 until you get to, I don't know, the mid-90s. And then the pattern shifts and looks very similar to the commercial real estate. But the reality is that incomes are not keeping pace with the increase of price. So does this make any sense to you? Well, that would be a no. But the reason why you see these behaving more like a stock than you do like a piece of real estate, which is not instantly liquid. I mean, maybe you can sell it in one day, but it might take you years to sell a piece of property. And that's because everything in these markets has been turned into a financial product. So where you and I grew up and we're used to thinking that, well, what are the markets? They're stocks, they're bonds, they're real estate. I'm not so sure about that, and maybe you'll agree or disagree after I show you what I'm about to. Because on top of all of these real extreme valuations, there are untold levels of leverage in derivative bets. Now remember, a derivative is derived from something that's underlying, and its price action is tied to the price action of that underlying asset or instrument. So I went into the Federal Reserve and I just put securitized in the search bar. Whenever you see the word securitized, what you need to know is that whatever it is has been turned into a financial product, financial engineering, or a security. So securitized means it's been turned into a security. And the search results pulled up 193 series. So it doesn't matter what has been turned into a product. As soon as they have been securitized, this is a very typical pattern. Now this line here shows you where the crisis hit, and this happens to be on consumer debt, so credit card debt, and you can see that it's a whole lot higher now than during the crisis. And they've been turned into a product and put in mutual funds and pension plans and all sorts of places. And it's just added layers of leverage. Can you see how similar this pattern is to this pattern? So this blue area with the stock market at the highest level, that represents equity. And the bonds represent the basic level of leverage or debt. But what's really been floating all of these markets up are those big leverage derivative bets. Can you see that? And can you see how close this pattern mimics it? Because that's what this market is really about. The stocks and the bonds and the real estate are teeny weeny pieces. It's really the derivative bets, and that's all that they are. And anybody that's been coming to these has seen this chart many times. This is from the Office of the Comptroller of the Currency, where on a quarterly basis they look at the derivatives in the FDIC insured banking system. Now, this is what I found particularly interesting when I pulled this one up. You see this area here where they're actually showing you the credit derivatives that killed the financial system in 2008 is just this little teeny blip here. I suppose that was supposed to make us feel better. But all of these legacy derivatives, this is what the IMF talks about and BIS, all those guys talk about. They didn't go away, they just got bigger. So if this little teeny piece here exploded the entire financial system, when a derivative event in this area is triggered, I mean, come on. Need I say more? But they know this. They know that derivatives are systemic and in the foundation of every single financial product out there now, because it's systemic through the entire system. So rather than demanding less derivatives or putting more control around them, etc., well, what do? Well, number one, they changed the bankruptcy laws in 2005. So they made it harder for people like you and me to declare bankruptcies, but those derivatives, bam, right to the front of the line. As you can see, this is from the FDIC. And I'm going to read it because this is way too small for me to read from the screen. But the ability to terminate financial market contracts, determine net amount due, and liquidate any pledged collateral quickly means that derivatives are more important than a normal vendor or, say, a bondholder, which is a debt holder, let alone an equity holder in any organization. And they go right to the front of the line. There's not going to be anything left for anybody else, in my opinion, and also in reality. Because it will go to the SIFIs, systemically important financial institutions, which are the guys that created the derivatives anyway. Now, we know that this is in the quadrillions, but they don't want that to be really understood or known. And we also know that whenever you see the word notional or nominal, you do not know the value at risk. That's simply the price that they've agreed to put on it. So they don't want you to understand how big it is, and you saw how it was declining in that FDIC chart. Well, let me show you how, according to the Bank for International Settlements, they can make 435 trillion in notional value of derivatives look like 9. And they just go through a whole bunch of little accounting gimmicks until, ta-da, there you go, 435 trillion become 9. This is called netting, and it hides the notional. So the notional hides the real value at risk, the netting hides the notional, but there are many ways that you can hide the notional. And compression is another one. So this is a new tool where they can take completely unrelated entities and see that they have an offsetting derivative contract and compress them to make it appear that it is less than it really is. And since they started this compression back in second quarter of 2013, well, you can certainly see that it was used a whole lot more once they figured out how to do this. So all of this is done to hide the truth, and by the time you see the truth, it's too late to do anything anyway, Because remember, the FDIC, which is where you probably have your checking and savings account, is telling you that derivatives go first in line in bankruptcy. So the question really is, how safe do you think any wealth held inside of this system really is? Because personally, I don't think it's safe at all.